we all create waste, right? I mean, it's a fundamental part of being a human society, something you can't really avoid. Most of the time, we probably don't think much about it past, dragging the bin out to the curb. But what if I told you the business of handling all that waste is incredibly essential, maybe surprisingly durable, and for one company we're looking at today, it's built like an absolute fortress. Welcome to the deep dive. Today, we're going to roll up our sleeves and really dig into the stack of sources you've shared with us. We've got everything from detailed investment analysis, financial data, right down to real customer reviews. And it's all focused on North America's biggest player in environmental solutions. Waste Management, Inc., ticker WM.
Exactly. And our mission here, it's pretty clear. We're not here to give you investment advice, not telling you what to do with your money. We're really here to guide you through all this material. We want to pull out the most important nuggets, uncover maybe some surprising facts hidden in the data, and just help you understand what really makes this particular business tick based only on the information we have in these sources.
Okay, sounds good. So let's get started. Let's just lay out the ground floor. What is waste management like at its core? And why is the work they do so, inherently sticky?
Right. So at its heart, waste management provides environmental solutions, mostly across North America. Their core activity, think of it as the really vital, maybe unglamorous work of collecting, transporting, and then disposing of waste. And they do this for a huge customer base. The sources say over 21 million customers. That's residential homes, commercial businesses, industrial sites, the whole range.
Okay. And looking at the sources, where's the money actually coming from? Can you break down those main revenue streams for us?
Yeah, the sources laid out pretty clearly. The biggest piece of the pie, 54%, that comes from collection services, just picking it up. Then you've got landfill operations at 19%. Transfer stations, which are sort of intermediate points, they contribute 9%. Recycling brings in 8%, and then there's a final 10% from various other services.
Okay, now here's where the sources seem to highlight something really fundamental to how they operate, their strength. It's not just about grabbing the trash from the curb. It's this thing they call the integrated model. What's that about?
Absolutely. This integrated approach is really a cornerstone of their profitability, according to this analysis we have. Waste management doesn't just collect the waste. Crucially, they also own and operate the landfills, where a big chunk of that waste ends up.
And the key term the sources use here is internalization. What does that actually mean for WM in practice?
It means simply that they collect the waste, and then they dispose of about 70%, really high percentage of that collected volume in their own landfills. This lets them capture essentially a second profit stream on the exact same load of trash. And the sources are very clear. This internalization directly leads to higher overall margins and much stronger operating cash flows compared to companies that maybe only do collection or only run landfills, but not both.
It's like they've built this kind of closed loop, right? Profiting at multiple points along the way. And the basic business itself, just dealing with waste, it just feels incredibly durable, doesn't it?
Oh, it has remarkable resilience. I mean, think about it.
Yeah.
Human activity generates waste. It's constant. Providing reliable collection and disposal, that's a basic public health necessity. Sanitation. Demand is what you'd call non-discretionary. It's tied directly to population growth, economic activity. It's not some fad that's going away.
Has the business changed much over time? I mean, the kind of stuff we throw out must be different now, right? Like electronics and things.
It certainly does change. Yeah. E-waste is mentioned as one example of those evolving waste streams. But the fundamental need to manage it, that persists. And the sources do highlight that WM is adapting. They're investing pretty heavily, putting significant capital into things like advanced recycling tech and developing renewable energy sources, like gas, from their landfills. These efforts line up with those broader sustainability trends you hear about.
So that vertical integration, owning, collection, and disposal, it seems like it creates this sort of built-in advantage for them.
It really does. Their collection routes essentially guarantee a steady flow of waste for their own landfills, making sure they run efficiently. And owning those landfills gives them a huge cost advantage because, well, they're not paying disposal fees to some third party. They are the third party. And those transfer stations you mentioned earlier, over 300 of them, they enhance this even more. They consolidate waste from local collection routes, which makes the long-haul trucking to the landfills more efficient. It effectively extends the reach, the service area, for their landfills.
Okay, so they've got this really enduring integrated business model. But what actually protects it? What stops competitors from just copying them? This is where we get into that idea of an economic moat, right? A competitive fortress.
Exactly. The sources really point to waste management's main competitive advantages coming from two key areas: intangible assets, and cost advantages.
All right. Let's tackle intangible assets first. What's the real standout there? The crown jewel.
Without a doubt, it's the landfill permits. The sources literally describe these as irreplaceable economic assets. Trying to get a new landfill permitted today is, well, it's extraordinarily difficult. You're facing huge regulatory hurdles, endless environmental reviews, and maybe the biggest wall of all, the universal not in my backyard problem.
Yeah.
NIMBYism. Finding a community that's actually willing to host a new landfill. It's almost impossible now.
Right. Politically, it's just a non-starter most places. So if you already have landfills with permits, those are incredibly valuable assets.
Precisely. And waste management sits on a vast amount of this permitted landfill space, or airspace, as they call it. Their landfills, on average, have nearly 40 years of remaining permitted capacity. Think about that. That's a multi-decade advantage that's just incredibly hard, maybe impossible, to replicate. It's a massive barrier to entry.
Okay, and what about the cost advantages? Where do those come from?
Those mainly stem from their sheer size, their scale, and what's called route density. Being the biggest means they can optimize collection routes much more effectively. More pickups for every mile driven. That directly lowers costs like fuel, labor, vehicle maintenance, all on a per customer basis. And then you layer on internalization again. Remember, that amplifies the cost advantage because they avoid paying those hefty tipping fees to third-party landfills fees that their competitors who don't own landfills absolutely have to pay.
Can you maybe paint a picture from the sources? How does this moat actually play out in the real world? What does it feel like on the ground?
Yeah, there's a good example mentioned. Think about a smaller local hauling company trying to compete with WM. Maybe they manage to win a collection contract, perhaps by undercutting WM's price slightly, but then they have to dispose of that waste somewhere. Now, if Waste Management owns the only reasonably close permitted landfill in that area, well, that smaller local hauler has to pay Waste Management tipping fees to get rid of the trash they just collected.
Wow. So they end up paying their direct competitor just to finish the job they won. That must make it incredibly hard to actually compete on price long term.
It really does. Those tipping fees become a major cost for the competitor, but they're pure revenue for WM. This dynamic, plus the overall scarcity of new landfill space, gives WM significant pricing power. As landfill capacity shrinks across the industry, tipping fees generally rise, and WM benefits directly. They can also add surcharges to collection fees with relatively little pushback, because, honestly, where else are you going to take your garbage? There often aren't many alternatives.
And the analysis you shared suggests this moat isn't just strong today, it's actually getting wider. What's driving that?
Yeah, it seems to be widening due to several factors. First off, industry consolidation. Waste collection and disposal is pretty much an oligopoly now, right? Dominated by WM, Republic Services, Waste Connections. WM uses its strong cash flow very strategically to buy up smaller competitors. Think about the big deals for advanced disposal in 2020, and more recently, Stericycle in 2024. Every acquisition like that removes a competitor, adds density to their routes in key areas, and secures more valuable disposal assets like landfills or transfer stations.
Okay, so fewer competitors, more density, stronger assets. What else contributes to this widening moat?
High customer retention is another big one. The sources mentioned commercial churn is low, only around 9%, and overall retention is over 95%. Once you're a WM customer, maybe you're locked into a multi-year contract, especially for municipal or commercial deals, which can be 3-10 years. But even beyond that, the sheer hassle and cost of switching providers, finding someone new, dealing with different schedules, maybe different bins, combined with the lack of truly integrated alternatives, just makes customers incredibly sticky. They tend to stay put.
And what about their big investments in technology, like automating the recycling plants or using those automated collection trucks?
Yes, that's another factor widening the moat. These big tech investments, they increase the amount of capital required just to compete effectively. It basically raises the barrier to entry even higher for smaller companies that just can't afford to match the billions WM is pouring into state-of-the-art facilities and equipment. It further solidifies their dominance through scale and technological advantage.
Okay, now, buckle up, because the sources point out something that seems totally counterintuitive, but apparently it proves how strong this moat really is. It's this issue of Waste Management's customer service, which, according to the sources, is not great.
Yeah, this is definitely one of the most striking points in the material we reviewed. Look at the specifics cited. A Better Business Bureau rating of just 1.07 out of 5 stars, and nearly 2,800 complaints filed just on that one site in only 3 years, detailing things like, constantly missed pickups, billing errors that never seem to get fixed, really difficult cancellation processes.
And I saw reviews on other sites like Angie describing them as the worst company ever or dealing with them as an endless nightmare. Ouch.
Right. Now, think about almost any other industry, retail, airlines, maybe software companies. Service that poor would lead to massive customer losses, right? People would jump ship the first chance they got. But waste management keeps these incredibly high retention rates despite these documented service problems.
So the argument in the sources is that the very fact they don't bleed customers because of bad service, that's actually evidence of how strong their competitive position really is.
Precisely. It suggests customers are effectively captured by that moat. Those high switching costs we talked about, the lack of viable integrated competitors, the fact that you have to have your trash collected. It all means it's often easier for customers to just tolerate bad service than to go through the pain and uncertainty of trying to switch. It's kind of a paradoxical testament to how insulated they are from competitive pressure.
That's fascinating, actually. So the complaints, while obviously real operational issues they should fix, they almost serve as data points illustrating the power of the moat itself.
That's the interpretation presented in the sources, yes. It really highlights just how much insulation they have from normal competitive pressures, especially around service quality.
All right, let's shift gears a bit. Let's look at the people running the company and the financial engine that powers this whole thing. Who's in charge over there?
The CEO is James C. Fish Jr. He's been in the top job since 2016, but he's a real company veteran. Joined way back in 2001, came up through operations and finance roles. So he knows the business inside out.
And based on what the sources say about his communications, the company's actions, what seems to be his guiding philosophy?
The sources paint a picture of a very let's say, owner-oriented approach. There's a clear focus on operational efficiency, cost discipline, like getting out of businesses that don't make enough money. He really stresses disciplined pricing, making sure price increases keep up with or even beat inflation. And critically, there's a strategic focus on making long-term investments that promise high returns, especially in that sustainability area we touched on. Plus, executive pay is tied to stock performance, which helps align management's interests with shareholders.
And how does that philosophy play out in how they actually use the cash the business generates? The sources mention it's a lot of cash, operating cash flow around, what, $4.5 to $5.5 billion a year?
Yeah, they have a very clear, disciplined capital allocation framework described in the sources. Top priority is reinvesting back into the core business. That means maintaining their fleet, their landfills, but also funding organic growth projects that offer high returns. And a huge piece of that right now is that multi-year, multi-billion-dollar investment program focused on sustainability, building those renewable natural gas or RNG plants at their landfills and automating their recycling facilities, their MRFs.
And the sources really emphasize these sustainability projects. They aren't just for show, right? They're expected to make serious money.
Exactly. The projected returns and payback periods are highlighted as being very compelling, like around a 3-year payback for the RNG projects, maybe 6 years for the recycling automation. They're explicitly described in the analysis as highly value accretive investments, expected to generate significant future earnings, not just environmental benefits.
Okay, so high return growth first. What's number 2 on the priority list for that cash?
Acquisitions, M&A. This is their main tool for consolidating the industry and making that moat even wider. The recent $7.2 billion deal to buy Stericycle is a prime example. That extends their reach significantly into the specialized medical waste sector. And the sources make a point of noting that management has a proven track record of successfully integrating these big deals and then quickly paying down the debt they took on to do them.
Right, and if there's anything left after growth and acquisitions.
And that cash gets returned to shareholders. That's the third priority. They've got a really impressive track record here, 21 straight years of increasing their dividend. And they regularly buy back their own stock, too. In 2023 alone, the sources say they returned over $2.4 billion to shareholders through both dividends and buybacks.
So does this whole approach pass the rationality test? Based on the sources, does management seem like they're being good stewards of the capital investors entrusted them?
Based on what's presented here, yes. Their stated capital allocation hierarchy seems very logical, very shareholder-friendly. Fund high-return growth first, make smart strategic acquisitions second, return the excess cash third. And the sources even point to their prudence, noting they temporarily paused share buybacks right after the big Stericycle deal, specifically to focus on getting the debt back down. That suggests discipline.
Okay, qualitatively then, how strong is this underlying financial machine, just looking at the big picture?
It's described as remarkably reliable, almost like an earnings machine. Revenue growth has been pretty consistent, going from under $15 billion back in 2018 to projected over $22 billion for 2024. Net income has grown alongside that. And the business has shown impressive resilience. It held up well even during tough economic times like the 2009 financial crisis and the initial shock of COVID.
Let's zoom in on a couple of specific financial ratios the source has highlighted. First, return on invested capital, ROIC. Why is that useful, and what do the numbers show for WM?
ROIC is a really key metric. It basically tells you how efficiently a company is using all the capital invested in its business, both debt and equity, to generate profits. How much bang are they getting for their buck? The sources show WM's ROIC has generally been high and improving, recently running in the 12-13% range. Now, that's comfortably above their estimated cost of capital, which the analysis pegs around 7%. So that difference indicates they are creating significant economic value. The slight dip noted in the most recent 12 months, that's explained by the big chunk of capital just deployed for the Stericycle deal, which hasn't had time to start generating its full earnings contribution yet. It's expected to recover.
Okay. And what about free cash flow conversion? That's the ratio of free cash flow to net income. Why do we look at that one?
Right, free cash flow is super important. It's the actual cash a business generates after paying its operating expenses and the capital expenditures needed just to maintain the business. It's the cash that's truly available for things like paying dividends, buying back stock, paying down debt, or funding totally new growth projects. Historically, the sources say WM has had excellent FCF conversion, often over 100%, meaning more free cash flow than net income. But they also note it's been lower more recently, around 85%, then 79%, and down to 69% in the trailing 12 months.
Huh. Is that a red flag? Does that mean the quality of the business is dropping?
The sources are pretty specific on this. No, it's not viewed as a sign of deteriorating quality. It's presented as a direct and, importantly, strategic consequence of that heavy capital spending cycle on those big, high-return sustainability growth projects we talked about, the RNG plants, the automated MRFs. They basically chose to front-load that investment. As that big wave of CapEx starts to moderate in the next few years, the expectation is that FCF conversion will normalize back towards those higher historical levels. So it's seen as temporary and strategic.
Got it. What about the balance sheet? Debt levels. How much leverage are they carrying relative to their earnings?
They have a stated target for net debt to EBITDA, a key leverage ratio between 2.5 and 3.0 times. That's generally considered prudent for this kind of stable business. Right now, the sources show it's a bit elevated, around 3.4x, but that's specifically because they just closed the big Stericycle acquisition. However, the key point emphasized is that management has a proven track record and a clear plan to use their strong cash flow to quickly pay that debt back down into their target range, usually within about 18 months post-deal. This focus on rapid deleveraging provides a kind of margin of safety.
Okay, before we look ahead to valuation and risks, the sources also included a little bit on the employee perspective. What did you glean from that?
Yeah, it seems employee sentiment is, well, mixed, maybe leaning towards average. Looking at a site like comparably mentioned in the sources, the overall culture rating comes out as the C+R. The areas that seem to rate higher are more transactional things like compensation, benefits. Confidence in the CEO also seemed okay, but areas flagged for improvement included things like professional development opportunities and maybe team dynamics, collaboration.
That focus on pay and benefits kind of makes sense, right? For attracting and keeping people in a pretty labor-intensive industry like waste collection.
It does seem logical. The sources do add an important grain of salt, though, noting some skepticism about these kinds of online review sites, suggesting companies can sometimes try to influence the scores. Still, a C+ isn't exactly glowing praise for the internal culture. While it's not presented as some immediate threat to the business or the moat, the sources sort of hint that over the very long term, if areas like professional development and team cohesion aren't addressed, it could potentially become a drag on things like innovation, maybe efficiency improvements, attracting really top-tier talent down the road.
Yep.
It's more of a potential long-term factor.
Right, let's try and bring all this together now and look towards the future. The million-dollar question, maybe literally for some listeners, is, given everything we've discussed, this high-quality business, the strong moat, rational management, is it actually available at a reasonable price today?
Well, based only on the valuation data provided right here in these sources, the conclusion drawn is that the current stock price represents a demanding entry point.
Okay. And what are those specific valuation numbers telling us? The multiples.
The trailing 12-month price-to-earnings ratio, the PE, is sitting around 35.5 times earnings. And the price-to-free cash flow multiple, PFCF, that's even higher, up around 51.9 times, though we know that FCF number is temporarily depressed by the capex.
And how do those numbers stack up compared to where WM stock has traded historically, according to the data?
Yeah, both multiples are significantly higher than their recent averages. The sources show the PE has averaged more like 32.3x over the last 5 years and 28.0x over the last 10 years. And the PFCF averages are around 32.6x over 5 years and 25.9x over 10.
Wow, okay, so that's quite a premium compared to its own history.
It really is. It seems the market clearly recognizes and appreciates WM's quality, right? Its defensive nature, reliable earnings, that strong moat we talked about, and it's pricing the stock pretty richly as a result. The sources suggest that buying in at these current levels leaves very little margin of safety. It feels less like you're getting a bargain on a great company, and maybe more like you're making a bet that the company's future growth will be strong enough to justify paying such a high price today. Even accounting for the distorted PFCF, that PE is notably elevated too.
So if growth is needed to justify that price, what is the primary engine the sources identify that could potentially fuel that growth and make today's premium valuation look reasonable over time?
It really comes down to the successful execution of that big multi-billion-dollar sustainability-focused capital investment program we've discussed. Specifically, building out those 20 planned renewable natural gas facilities at their landfills and automating those 39 recycling centers, the MRFs.
And what kind of bottom line impact are they projecting just from those two big initiatives?
Management is projecting, according to the sources, that these projects together will add over $700 million in incremental annual EBITDA. That's earnings before interest, taxes, depreciation, and amortization by around 2026 or 2027. And given those high projected returns we mentioned, especially that quick 3-year estimated payback on the RNG plants, the sources view this as a highly visible, value-adding, and potentially pretty significant new earnings stream that could really accelerate WM's overall growth rate in the coming years.
Okay. Now, every business faces risks, especially long-term ones. What are the most serious threats, the kind that could cause permanent damage highlighted in the sources, the ones that could fundamentally challenge this whole business model?
Yeah, the sources focus on 3 main ones. The first is regulatory obsolescence.
What exactly does that entail? What would that look like?
It means a fundamental, maybe slow-moving, but ultimately decisive shift in environmental policy, or even just public perception about waste. Think about a mandatory widespread push toward a true zero landfill society. Or maybe regulations that just make operating landfills prohibitively expensive or complex. Something like that could dramatically devalue their core landfill assets, which, as we've discussed, are absolutely central to their moat and profitability. Now, the sources call this a low probability risk in the medium term, but they flag it as probably the biggest potential long-term threat to the existing business model. And remember that poor customer service issue. The sources actually suggest that persistent public frustration could potentially become a political catalyst down the road, leading to increased regulatory scrutiny or pressure on the company. It's an interesting potential link.
Yeah, that is interesting. Bad service potentially fueling regulatory risk. Okay, what's the second major long-term risk identified?
Technological disruption. This would be some kind of breakthrough in waste processing technology. Maybe something like advanced plasma gasification becomes truly viable and scalable, or maybe truly effective chemical recycling takes off, or even revolutionary new materials are developed that change how we handle waste entirely. Something that fundamentally challenges or diminishes the need for and the value of traditional large-scale landfills. Now, WM is investing in newer technologies themselves, as we noted, but external innovation from startups or competitors is always a real long-term threat if it manages to outpace their internal efforts and undermine that core collect-and-bury model.
Right. And the third potential major pitfall mentioned?
A major M&A misstep. Yeah, despite their generally pretty good track record on acquisitions recently, a future large deal that's maybe poorly integrated, or one where they vastly overpay, or maybe one that takes the company too far outside its core areas of expertise that could destroy a lot of shareholder value. The integration of the very large Stericycle deal is specifically mentioned as the immediate near-term test of their ongoing ability to successfully digest these major acquisitions without tripping up.
Okay, stepping back for a moment. What's the overall consensus view of waste management out there in the market, according to these sources? How do most analysts see it?
Well, the prevailing view described is that it's definitely a best-in-class industrial company, no question about that. The market widely recognizes the strong moat, the stable, resilient earnings profile, the capable management team.
Yeah.
So analyst recommendations often seem to hover around moderate buy or maybe hold. And that's largely because, while the quality is acknowledged, the stock is generally seen as being fully valued, maybe even richly valued, at current prices. So limited, obvious big upside in the near term.
But the sources also introduce a slightly different angle, right? A kind of second-level thinking, or maybe a contrarian view. What's that perspective?
Yeah, the contrarian perspective that's highlighted is the idea that the market might be significantly underestimating the long-term earnings power and the potential for margin expansion coming from the renewable natural gas RNG business.
Okay, how does that differ from the standard view you just described?
Well, the market consensus tends to see the sustainability investment, including the RNG part, as valuable, sure, but maybe more like an incremental addition, nice kicker to the core business. The contrarian view, though, looks at that projected $700 million plus in initial annual EBITDA from those first 20 plants as just phase one, just the beginning. The sources note the potential for very high returns on these RNG investments, maybe over 30% unlevered return. And if that holds true, it essentially creates a repeatable blueprint that WM could roll out across its vast portfolio of existing landfills, potentially turning them into energy-producing assets over decades.
So it's not just seen as an add-on in this view, it's potentially transformational.
Exactly. If this contrarian view turns out to be right, it could fundamentally reshape WM over the long term, moving it from being primarily seen as just a waste company towards more of a hybrid industrial utility energy company with potentially a structurally higher margin business mix overall. So the argument is the market today might be valuing the initial investment in this new platform, but perhaps not the full decades-long potential for value creation it represents. And if that's right, then the price that looks demanding today could actually appear much more reasonable if you look out, say, 10 years, assuming this higher margin business grows and the market eventually re-rates the stock accordingly.
Okay, let's try and quickly summarize the bull case then. Based on everything in these sources, what are the strongest arguments for why someone might want to own WM?
All right, bull case in a nutshell. You've got the foundation of those irreplaceable landfill assets creating a wide, durable moat. You have exceptional pricing power, driven by resilient demand for an essential service, plus the efficiency boost from vertical integration. You've got management that appears rational, shareholder-friendly in its capital allocation funding, high return growth, making smart consolidating M&A and returning excess cash. And importantly, you have a visible new, potentially high-return growth engine coming online with those sustainability projects, especially RNG.
Okay. And flipping that coin, the bear case. The strongest counter-arguments, again, based just on these sources.
Bear case. First and foremost, a demanding valuation that offers very little margin of safety at current stock prices. Second, that systemic, widely documented poor customer service, which poses both reputational risk and, potentially down the line, regulatory risk. Third, the execution risk tied to integrating large acquisitions like Stericycle and the temporarily higher debt levels on the balance sheet that come with it. And fourth, that long-term, maybe lower probability, but still real risk of technological obsolescence eventually challenging the core landfill-centric business model.
Finally, the sources challenge us with this red team scenario. What's the single most compelling argument presented for why an investment in WM today might turn out to be a mistake? What's the nightmare scenario?
The most potent downside argument presented seems to be the possibility that those projected high returns from the big sustainability growth engines, specifically RNG and automated recycling, simply failed to materialize anywhere near expectations. This could happen, for instance, if commodity prices like natural gas prices or the prices for recycled materials suffer a sustained significant downturn. That would severely impact the actual profitability of those multi-billion-dollar investments they're making.
And if that disappointment happens while the core business is also facing some headwinds?
That's the perfect storm scenario described in the sources. If that new growth engine underperforms and, at the same time, the core business starts to face real negative consequences from those persistent operational issues, like the poor customer service, maybe leading to political or regulatory backlash, maybe losing key contracts, maybe facing price caps, then you'd be left holding a stock with a premium valuation, but attached to a slow growth core business and underperforming new assets. In that kind of scenario, the market would likely re-rate the stock dramatically downwards, right? From its current premium multiple, say 35 times earnings, maybe back towards a more typical industrial multiple of, say, 15, 20 times earnings.
Yikes. And that combination of the multiple shrinking and earnings being stagnant or even declining, that could easily result in a huge price drop, maybe 40, 50%, or even more, representing a real permanent loss of capital for someone buying at today's already high price.
That's basically the most compelling downside risk articulated in the sources. It really highlights the risk you take paying a premium price today that implicitly relies on future execution and external factors, like commodity prices, aligning pretty perfectly.
And with that sobering thought, our deep dive into this stack of sources on waste management comes to a close.
Yeah, we've really covered some ground, from the basics of how they make money through exploring all the layers of that surprisingly strong moat. We dissected their capital allocation strategy, looked at the financial health, and then weighed the potential risks against the different ways the market might be viewing their future, especially with that big energy bet.
And this is really the power, isn't it, of actually digging into the details within the source material itself. It reveals all those nuances, the hidden strengths you might miss, maybe some surprising weaknesses, and those contrasting viewpoints that you just don't get from a quick surface level look at a company.
Absolutely. And maybe as you, the listener, continue your own explorations, here's something to leave you with, something to sort of mull over based on everything we've unpacked today. Considering that bedrock strength of those irreplaceable landfills, but then juxtaposing it with those persistent, undeniable complaints about their service quality, and then factoring in this bold bet they're making on transforming waste into energy. Is the market truly grasping the full long-term potential of waste management evolving into something more like a higher margin energy or utility business? Or conversely, could that visible, seemingly tolerated poor customer service actually be the real long-term Achilles heel? Could it be a kind of regulatory time bomb that ultimately proves a bigger challenge to their moat than any new technology ever could?
Something to think about indeed. Thanks for joining us for this deep dive.